Good evening, ladies and gentlemen. This is Barry Norman on behalf of CMS Market Trader and Investing.com, and welcome to our webinar on the key to technical indicators and understanding the different types of indicators. Now, tonight's class is brought to us by CMS Trader, one of the world's leading Forex and CFD providers. Now, CMS Trader is a regulated provider, so I'm therefore required to give you a risk warning. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. Now, if you want, during class tonight, you can go to www.cmstrader.com, and when you open up the homepage, you'll see a chart just like we have that shows buy and sell. If you click on either one, it's going to ask you to enter your email address and pick a password, and it'll immediately open a demo account for you. Now, if you can't access cmstrader.com because it's blocked, it means that they are not regulated in your home country, and they only do business where they are regulated by the government because they are one of the world's leading platform providers. Now, CMS Trader offers many advantages. They believe in investing in educating their clients, as well as providing impeccable service and guaranteed security. There's no dealer intervention and no conflict of interest. They also offer free daily signals, free daily market updates and technical analysis, and exceptionally fast trade execution. They offer a wide range of instruments, including Forex, CFDs for stocks, commodities, and indices, as well as providing their Watch, Copy, Profit social media outlet. And you can watch their best traders trading and duplicate their trades with one click. You don't have to invest the same amount they're doing, and you can decide whether you like their trade and just click on a copy trade and you'll be able to duplicate their trades. You can also learn how to become an independent trader with CMS Trader by taking part in using their video tutorials, as well as one-on-one sessions with financial experts and their full library of ebooks. But CMS Trader will do whatever is possible to help you become the best trader you can be. Now, tonight we're going to talk about the different types of technical indicators. Now, traders who subscribe to technical analysis or the theory of technical analysis operate under the fundamental theory that price moves in patterns and that price never lies. So in other words, price action on your chart is the ultimate determining factor. So to the inexperienced eye, a financial chart may look like an unpredictable line with a jumble of colors and marks. But these traders are watching charts to pick up on the subtlest of indicators of where share or asset prices could be headed next. So here we're going to look at a breakdown of the most common technical tools that traders are watching and what they could mean. Now, the main similarity between technical analysis indicators is that they all use open, high, lows, closes, and volumes in their calculations. This small number of variables has produced hundreds and even thousands of trading indicators. You know what they are. You hear them all the time. MACD, Bollinger Bands, RSI, Stochastics, Williams percent R, CCI, ADX. There's an unlimited range of them. Now, we all hear about all the popular ones, and almost every one of them is included now in the new modern Java charts and computerized charts and HTML charts, where you can just click on a button and drop the indicator on your screen. Now, remember, the whole school of technical analysis isn't just about indicators. There's trend lines, there's support and resistance levels, there's volume, and then there's technical indicators. Technical indicators are these mathematical calculations that you either lay over your price chart or fall below your price chart. Now, technical indicators fall mainly into two categories. These are called leading and lagging indicators. Leading indicators are those who lead the price movement. They give us a signal before a new trend or a reversal occurs. Lagging indicators are those who follow the price action. They give a signal after the trend or the reversal has started. Indicators from both categories belong in or fall into these 5 main types. And this is what's important now. Too many traders don't understand what the different types of indicators are, and therefore they pick up or follow somebody's strategy who's using 3 indicators that fit under, say, volatility indicators and ignore volume, momentum, and trend. Well, to be honest with you, you never really need more than one per type of indication, because using RSI and stochastics only fall over top of each other. Okay, so these are the main categories: trend, volume, volatility, or volume indicators. Now, when we start out with the first and most popular one and the most well-known is called trends. This is not a trend line. Okay, these are indicators that tell you or help predict what the trend is about to do. Identifying trends over different time frames are useful because it helps weed out the noise of daily volatility. Any type of trend, including uptrends, downtrends, and sideways trends, can be traded for a profit so long as it's shown itself to be consistent. Okay. Trend traders use a number of different indicators to help them figure out what kind of trend an asset is in. One of the most popular of these indicators is moving averages, which is represented by a single line that represents an asset's average price over a given period of time. You can do as a 50-day moving average and a 200-day moving average. If you're using slow-moving stocks, you can use different combinations that you can use. But moving averages tend to smooth out price and help predict where price is going. Other examples of trend indicators include moving average or moving average convergence and divergence, which is called MACD, ADI or ADX, which is average directional index, and linear regression. There's many different indicators that fall into this category. So you have to be aware when you're selecting an indicator what category it falls in and what it's trying to tell you. Then, of course, we go to volume indicators. Volume is the measure of the total number of shares or contracts that trade in a given period of time. Where volume really comes in handy is confirmation. Many traders use volume to confirm the conclusion of other types of indicators, such as a trend. So in other words, if we're seeing volume indicators move on the upswing, in other words, more contracts or more shares are being bought of an asset or traded of an asset, that means the traders strongly believe in what the other indicators are telling you, and they're jumping into the market or out of the market. So sometimes market conditions or the lack of liquidity alone can temporarily drive an asset price higher or lower. However, these moves are often occur on relatively low volume and can be short-lived. So when you don't see volume changing or climbing, or volume is very low, it's going to tell you this move that you see in price is only a short-lived blurb. It's a freak at the time. The traders are not supporting it. On the other hand, if an asset makes a big move on extremely high volume, that's a reliable signal that there's major buying or selling going on, and the move should be taken serious. Now, of course, we can drop volume straight on our charts, or we can use other types of indicators that we have: money flow index, Chaikin money flow index, on balance volume, demand index, and force index, which are all indicators that use a calculation using the volume. And these can be used to confirm price movement. Then momentum, which is my favorite. Momentum indicators are like speedometers for traders. They show how fast an asset is moving in a given direction. These indicators are typically displayed as oscillators. These fluctuate above and below a baseline level to indicate how much positive or buying momentum an asset is experiencing. So these are like, and they're very popular in the market, RSI, stochastics, because these are called what we call bounded oscillators, because they move, and their calculations, in the case of these two, always will come out between a 0 and a 100. Okay. But there's other bounded indicators that use between 0 and -1 and +1. There's some that stay in a range of 10 to +10 and -10. Whenever they're bound in a range, they are considered a bounded oscillator. So for instance, RSI will always come in between 0 and 100. And we ignore the numbers between 30 and 70, and above 70 tells us something, and below 30 tells us something. Okay. And if an asset moves below 30, that is a signal that the asset is oversold and the buyers could soon come in and drive the price higher, or the opposite. So these include momentum indicators like stochastics, CCI index, Chandy's momentum indicator, and one of the most famous, Williams %R. So if you were to combine a momentum indicator and a volatility indicator, okay, and a volume indicator, you would have a fairly good trading system. But if you were to combine 3 trend indicators and ignore the others, you'd have a terrible trading system. And when somebody's talking to you, or you're learning about or reading about, if you don't understand what category these indicators, that you need to say, why do I want to add this into my trading? What is it going to add to my decision-making capabilities? So volatility is the measure of how large an asset's movement in a given period of time tends to be. When an asset makes a large move in a short period of time, it is considered volatile. Volatility is a very important indicator for traders because volatility makes it easier to make profit due to price inefficiencies. Without volatility, trading opportunities would be very limited. Okay. So we have things like the VIX. We have Bollinger Bands. We have envelopes. Okay. When we can, number one, ascribe to the volatility or understand the volatility in the market, we can figure out where we would have to place our stop loss to remain in our trade to cover the volatility of the market. This will help us a great deal to decide whether we can afford to make that trade. How much profit could we make if the asset went in our favor? And can I afford that loss if it doesn't? Or at what point will it stop me out? Can I afford that and make you determine whether that volatility is worth making the trade? Because sometimes you can have a perfect trade, but you didn't really calculate in the volatility. And that trade, even though you say the euro is going up and the euro goes up, it is very volatile. So it will have volatile swings up and down. And you could have been completely right. You opened that euro at 119.27 and it soared up to 121.97. You missed 200 points. But what happened was you could only afford to put your stop loss at 119, and it swung down to 118.50 in a 1 second, but your stop loss closed you out and you never got the benefit of that ride. And as though if you couldn't afford to trade that volatility, because you couldn't afford to put your stop loss any lower, because if you were wrong, it would wipe out your entire portfolio, you shouldn't be making that trade. Now, once we've grouped these indicators and we understand the grouping of these indicators, we then have to separate them into what's considered leading and lagging. So when we look at the most popular trend indicators, which are moving averages and moving average convergence and divergence, parabolic stops and reverses are quite complicated, but they are also one of the leading ones. And so we simply call them parabolic SARs, which stand for stop and reverse. But if you notice, 2 of those fall into lagging indicators. Only one is a leading indicator. Okay. Now, moving averages are used to identify current trends and trend reversals, as well as to set up support and resistance levels. MACD, which you're going to find is a very utilitarian indicator because it actually falls in several areas, is used to reveal changes in strength, direction, momentum, and duration of trend. And it is also considered a lagging indicator. But at the same time, you can use parts of MACD as a leading indicator. And we'll see, we'll come to that in a minute. But it's very important to be able to decide also, do you want to have leading or lagging indicators? Because leading indicators will give trade signals when the trend is about to start. Okay. Where lagging indicators are those that will follow the price action and let you know that a new trend has started. So a lagging indicator, now don't miss, too many people miss the understanding of a lagging indicator. It's not a negative connotation. They give a signal after the trend or the reversal has started. So when they give that signal, it means the new trend has already begun. So it's saying get into the market, where a leading indicator is telling you that one is about to start. So a lagging is you would use them to determine a trend. The most common lagging indicator is moving average, whereas leading, they try to predict price by using a shorter period in their calculations, thereby leading the price movement. The most popular leading indicators are stochastics, MACD, and RSI. So listen, we just told you MACD here is a leading indicator, but we told you over here MACD is a lagging indicator. So MACD is one of the most interesting because MACD gives you three different pieces of information. It will give you overbought and oversold conditions. It will give you crossovers, and it will give you divergences. So this is one of the reasons that MACD is such a widely used, in fact, it is the most widely used indicator of them all because it will fall into all three categories, where stochastics and RSI are only leading indicators because they predict when a market is overbought and oversold. And they do not actually give you entry and exit points, where MACD will actually tell you, give you a signal to enter the markets. So these technical indicators measure the strength of a trend by comparing price to an established baseline. Moving averages are used to identify trends and reversals as well as to set up support and resistance levels. Parabolic stops and reversals are used to find potential reversals in the market, and moving average convergence and divergence, which I keep talking about because it's one of my favorite indicators, is used to reveal changes in strength, direction, momentum, and the duration of the trend. These indicators are designed to show traders and investors the trend or direction of the asset they are trading. The trend of an asset can be either downward or upward or sideways. Trend followers are an example of traders who use trend indicators to analyze the markets. Once we move away from trend indicators, we move over to another category, and these fall into stochastics, the stochastics oscillator, the relative strength index, our RSI, and CCI, commodities channel range. These are momentum indicators. Now, this again gets a little bit confusing because stochastics, as you saw, and RSI are leading indicators, but they're not trend indicators, they are momentum indicators. So stochastics is used to predict price turning points by comparing the closing price to its closing price range. So it's a leading indicator. CCI is an oscillator to help identify price reversals, price extremes, and trend strength. Again, a leading indicator in the momentum indicator category. RSI, relative strength, measures an asset's recent trading strength, and again is a leading indicator. Why? When you're calculating RSI and stochastics, which are bounded oscillators, they tell us above 70 or below 30. Okay. When these numbers occur, they're telling you the markets are overbought or oversold. They are predicting what the markets will do. So they are telling you ahead of time. A lagging indicator would tell you the market has just turned. A leading indicator tells you the market is about to turn. So overbought and oversold conditions are leading because an overbought indicator can remain overbought for a period of time. Now, they fall in this category called oscillators, as I mentioned earlier. These technical indicators may identify the speed of price movement by comparing the current price to previous closes. The Stochastics oscillator is used to predict price turning points by comparing its close. RSI we've gone over, and CCI we've gone over. But the momentum, now what is the momentum? Why do we want to include momentum? The momentum is a measure of the speed at which the value of a security is moving in a given direction. Momentum traders focus on stocks and assets that are moving significantly in one direction on high volume. So as you can see, momentum indicators are essentially composed of oscillating indicators that are usually used to determine overbought and oversold positions. Now we come back to the category of volatility indicators. The three of the most popular are standard deviation, ATR, which is average true range, and Bollinger Bands. Of these, the only one that is really popular with most online traders is Bollinger Bands. The Bollinger Bands were developed in the 1980s by a statistician named John Bollinger. It has been so popular for so many years that it has become, outside of MACD, the second most used indicator. And John Bollinger continues keeping his own website, which is very important information. And you can access that by going to Bollinger Bands and looking up the website for Bollinger Bands. I don't know if it's www.bollingerbands or not, but then you get it straight from the horse's mouth. You're not getting all these other people that are applying their own strategies and trying to tell you what to do. But it is one of the most popular. Now, Bollinger Bands are one of the few indicators that is dropped on a price chart over top of the price. And you see the volatility by the contraction and expansion of the bands on either side of the price. So it's used to measure the highness and the lowness of price. And people say, and most traders, and I also use Bollinger Bands, that everything you need to know and do and understand about price movement is contained within those bands. You can get where you have to put your stop loss, where you should put your take profit. It'll give you entry points. It gives you everything within these bands. But it is considered a lagging indicator because it tells you after it has already started to occur. So it needs to be, when you're having lagging indicators, it needs to be you've got it ready to go to action when you get these signals. Leading indicators give you a little bit of time ahead of time. So now volume, these technical Bollinger Bands, as we talked about, measures the highness and lowness. It puts two bands above and below the price using what's called standard deviation. And it is one, like I said, one of the most popular movements. Now, volatility is so important in trading that you can find several indicators that measure or use it to generate signals. The volatility is the relative rate at which the price of a security is moving up or down. A high volatility occurs when price moves up and down quickly over a short period of time. If price moves more slowly, then we consider that as low volatility. And unfortunately, in CFD and Forex trading, low volatility doesn't help us generate profit. Okay, because that means the price is going to move in a slow, steady manner. Okay. And in market inefficiencies, we need volatility. You also need volatility to make profit. So some of the volatility indicators include our Bollinger Bands, envelopes, ATR, volatility channel indicators, projection analysis. And then again, we talked about volume. You can actually drop the actual volume on the chart. There's other indicators that get very complicated on volume. And I use the straight volume indicator that shows me the actual volume. There's others, especially if you're trading stocks, that will help you balance it out, and that's volume rate of change, on balance volume, or Chaikin oscillator. These are a little bit harder to learn to use. They are fairly reliable, but volume should be always factored into your trading decisions. These technical indicators measure the strength of a trend based on the volume of shares or contracts being traded. The volume of trades is a very important component to trading. It is, for example, used to confirm or infirm a continuation or a change in direction. Many indicators are based on volume. For example, the money flow index is an oscillator tied to the volume that measures the buying and selling pressure using both price and volume. Now, somebody got in with a very smart answer because they didn't want to listen to the class, and they said, I only mentioned 4 types of indicators. Okay. And there are only 4 types of indicators, but we said there are 5 things you must know about indicators. And the 5th is what we call overbought and oversold. You hear it talked about quite often. Okay, there's many indicators that will give you overbought and oversold conditions. When a security is overbought, the implication is that buying has pushed the price too far and a reaction called a price pullback is expected. When an asset is oversold, the implication is that selling has pushed the price too far down and a reaction called a price bounce is expected. Now, indicators will help give us information by generating signals. Some will tell us volatility levels, some will give us overbought and oversold conditions, some will give us signals by what's called convergence, some will give us signals by what's called divergence. Okay. Now, the job of an indicator is to indicate. Remember that always. Okay. An indicator or technical indicator is always your secondary decision-making tools. They are not your primary decision-making tools. Whether they're leading or lagging, whether they generate signals or not, okay, they are not your primary decision-making indicators or tools, because price action is ultimately the first decision-making factor. Price volume, and then if you add in trend lines, not trend indicators, but trend lines, support and resistance levels are your secondary or your next phase. Then you need to then make a decision. Is this correct? Okay. And you'll use an indicator to do that. Indicators are filters. Now, this may sound straightforward, but sometimes traders ignore the price action of an asset and focus solely on an indicator. Now, indicators filter price action with formulas. Now, an indicator can give you a trading signal or an alert. For instance, moving averages, when they give you a crossover, or MACD when it goes above or below 0, can be giving you an indicator. But then it's saying, go to price. It's just saying, hey, dummy, hitting you in the head, look at your price chart. Okay. Then you need to look at the price action on the chart. Your primary indicators could be chart patterns, things that are done right on a chart using price movement. So as such, indicators are derivatives. They're not direct reflections of price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. What is the indicator saying about the price action of an asset? Is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, the signal should be taken in context with other technical analysis tools. Now, when I say technical analysis, people start to think, he said technical analysis. Okay. There's a difference between technical analysis and technical indicators. Technical analysis is the entire thing of everything that takes place on a price chart. Whether you're using chart patterns, whether you use Japanese candlesticks, whether you're using trend lines, whether you're using support and resistance lines. Technical indicators is what we're here about tonight, are these mathematical calculations that are put on graphs and charts either over top of the price action or below the price action. And these are indicators. Okay. So an indicator may flash a buy signal, but it's the chart pattern shows a descending triangle with a series of declining peaks. It's a false signal. Okay. As always in technical analysis, learning how to read indicators is more than an art than a science. The same indicator may exhibit different behavioral patterns when applied to different stocks or assets. Indicators that work well for IBM may not work the same for Delta Airlines, or indicators that work great for Forex may work terrible for cryptocurrencies. So through careful study and analysis, expertise with various indicators will develop over time. As this expertise develops, certain nuances as well as favorite setups will become clear. Because there are hundreds of indicators in use today. With new indicators being created every week, technical analysis software programs come with dozens of indicators built in and even allow users to create their own. So before we go on, let's go look at some real live charts that I've got set up for you, and let's look at how you would use these in conjunction with price action. So let me click over to the live charts I got for you. Okay, now we're looking at a very simple, clean chart. It doesn't matter. We're not talking about right now. We're not making trading suggestions, and we're not giving you a signal. We're not telling you to trade an asset. We're simply telling you how to use a combination. Now, what you see is a simple bar chart. Okay, we're looking at a 2-hour chart for the Australian dollar. We've already determined where our support and resistance lines on our chart. And if you don't understand support and resistance, you need to come to a class because it's a very crucial concept. Now, we have something that's called bearish divergence. Do you know what that is? Okay. It's one of the ways that you would use an indicator. When you have an indicator such as RSI on your chart, and the indicator is moving in one direction, opposite the movement in the price direction, they are diverging. So here our asset is making higher highs as it's moving up, while our indicator is making lower lows. So we have a divergence. That tells us something about the market and gives us some ways to make, or tells us we should be doing something. So in this case, it was telling us that this trend is most likely ending. It's giving us what's called bearish divergence. Okay. And this is a combination of using price action first and your indicator as your second line of defense. Because what else do we get here? Price has moved up to this major resistance line and is expected to bounce off of it and fall down. This is giving us a confirmation that we're going to see a downward movement. If we see price bounce off this major, we could then get in and enter this market for a downward trade or a short sell. In this case, in the next case, let me just get these markings off of here. We have the euro US dollar. Okay. Here we're simply using moving average crossovers. So we're using a longer and a shorter moving average. And when they cross, so in your 25-day EMA crosses your 50-day EMA. Now, E is for exponential moving average, is a type of moving average. Okay, we would have to make a decision. Okay, and we see we have a price channel. We see we have the crossover here. And when if you learn to understand moving averages, when your slower moving average, which would be your 50-day crosses over, it would be a sell signal when your shorter moving average, which is called your faster moving average, crosses the slower moving average. That's a buy signal. Okay, so here you got the crossover, and the EMA 25 crossed over the EMA 50, and that gave us a buy signal. And look at how that asset soared up after that crossover. Okay. This is using simple moving average convergence, but we're using price action on the charts. And then thirdly, we have Bitcoin. Let me pull this over for us here. Okay. And here, again, now we're using RSI on the bottom. RSI is staying, what I call dead man zone, is staying between the 30 and 100 level. So it's giving us no indication here, but we're primarily using our price lines and our support and resistance on our chart to determine what we think is going to happen. So as we can see, is price moved up, and we gave us a double top at this price resistance line of 16,864 and bounced off of it. It came down and gave us a beautiful downtrend that you could have traded. Now it's hit the next support level, and we're expecting it to bounce up towards the next resistance at 17,067, or go as hard as 19,599, and then to bounce off of those, coming back to the support level. Now, these are our predictions. Okay. What we would like to do is see, as we're moving towards this point, we'd like to see the indicator move below the 30 level to support our upward movement. And when it falls upward and gets ready to bounce down off of the resistance, we'd like it to see it go above 70. So we have all of this is price action on a chart. This is price action and support and resistance and trend lines. And we're using our indicator as our secondary confirmation tool. So we would like to see this happen. When it bounces off, we would like to see RSI in one of its two frames. So this is why they're second. You don't use them as primary. Looking at price is the ultimate primary, and then support, resistance, trend lines, and chart patterns should be your primary decision making. And then it's supported by your indicators. So you can see three different ways that indicators or technical indicators are used with your charts. So let's go back to my PowerPoint. So there are hundreds of indicators in use today, with new indicators being created every week. Technical analysis software programs come with dozens of indicators built in and even allow users to create their own. Given the amount of hype that is associated with indicators, choosing an indicator to follow can be a daunting task. Even with the introduction of hundreds of new indicators, only a select few really offer a different perspective and are worthy of our attention. Strangely enough, these indicators that usually merit the most attention are those that have been around the longest, have stood the test of time. And where are they? We have stochastics, we have RSI, we have Bollinger Bands, and MACD. You can do all of your trading systems using those and combine them with candlesticks, support and resistance volume indicator as true volume, and you can use any of those to cover and make complete trading decisions. But when choosing an indicator to use for analysis, choose carefully and moderately. Attempts to cover more than 5 indicators is usually futile. It is best to focus on 2 or 3 indicators and learn their intricacies inside and out. Try to choose indicators that complement each other instead of those that move in unison and generate the same signals. For example, it would be redundant to use 2 indicators that are good for overbought and oversold levels, such as using stochastics and RSI at the same time. Now, there are many traders that believe it. In fact, there's an indicator called stochastics RSI. Okay. But both of these indicators measure momentum and give us overbought and oversold limits. So if you're a smart beginning trader, stick with Bollinger Bands and MACD. Use real volume on your charts. and use trend lines, chart patterns, and support and resistance. And remember the difference between leading and lagging indicators. So as their name implies, leading indicators are designed to lead price movement. Most represent a form of price movement over a fixed look-back period. So there are benefits and drawbacks of leading indicators, and like we've discussed throughout the class, these are clearly many benefits of using leading indicator. Early signal for entry and exit is a great benefit. And to me, the biggest advantage to a leading indicator is that they give you a little bit of time because they tell you before something's going to happen. That gives you a few other minutes or a little bit of time to make other trading decisions. But they also generate more signals. Leading indicators are best used in trading markets. These indicators can be used in trending markets, but usually with a major trend, not against a trend. Lagging indicators, as their name implies, lagging indicators follow the price action and are commonly referred to as trend following indicators. One of the main benefits of trend following indicators is the ability to catch a move and remain in a move, provided the market or security is develops a sustained move. And lagging indicators will help you enter at a good point and catch the broad movement of that asset. Now, for technical indicators, it is a trade-off between sensitivity and consistency. In an ideal world, we want an indicator that is sensitive to price movement, gives early signals, and has few false signals. And we all dream. If we increase the sensitivity by reducing the number of periods, an indicator will provide early signals, but the signals will be false. So there's a whole lot of people out there that want to modify indicators. Like, MACD uses a 9 and a 12-day moving average, or a 9 and a 26-period moving average with a 9-day average after that. There's people that want to modify it all different shapes and ways. Well, the fact is, it's no longer MACD then. It's Barry's indicator. Because then you have to back test it, you have to up test it, you have to use constant testing, because it might work great for today, but it might not work in a longer term, because now you've modified the sensitivity of that indicator, and you don't have any idea how it's going to react, because every market reacts differently. If you use it the way the indicator was developed, at least it's been back tested for years, and you know exactly how it'll work. Okay, it's just like Bollinger Bands is a standard 2-period moving average. Now, you can be like me. I've used it for 40 years. Well, I've used it since 1980 anyway. Not 40 years, but it came out after I started trading. But I've adjusted it to a 2.5 level instead of a 2 standard deviation. But I've tested it for years because I want to get less signals. I want a higher quality signal with less signals. Okay. But that is my testing, and I know how it works for me. And it took me a very long time to make sure it worked. Okay, but if you want to use Bollinger Bands and you want to read all the theories and do all the tests, it works. It's done and tested with a 2 standard deviation. Again, you can make it 2 3/4. You can make it 2.25, but then none of the rules in the testing work. Doesn't mean the indicator doesn't work. You have to then determine how it will work. So it's no longer, in that case, Bollinger Bands. It's Billy's Bands. So if we increase the sensitivity by reducing the number of periods, an indicator will provide early signals, but the number of false signals will increase. Even moving averages. If you read and learn about a 10-period, 20-period moving average crossover, okay, and how to use it, interpret it, it's because somebody's tested it for a very long time. And this is why they've lasted the test of time in the marketplace. But you can decide you want to use an 8.5 and a 42. It works, but you have to figure out how it's going to work. So remember the different types of oscillators. Remember the different types of indicators. Remember what categories they fall in, and carefully pick what you would like to incorporate into your trading system. And note, I said your trading system, not Billy Bob's trading system that you're trying to adapt. Every successful trader and every smart trader you find out there builds their own trading system, builds their own strategy. You can use RSI, which is a known, and follow and learn what RSI does, but you incorporate that and don't do trades because some guru out there said when RSI moves from 67 to 72 and hovers at 72 and then jumps to 74, go buy. Please don't do that. Learn what RSI is about and decide if you want to incorporate that in your trading system, because then you'll be able to see when it's going to work in the market and when it doesn't. You'll understand when the markets are giving you false signal. But if you don't understand it, you're just going to trade every time it goes to 62 to 72 and then trade when it jumps to 74. Believe me, you'll lose your money. So stick with the big one. Stick with MACD. Stick with Bollinger Bands. Stick with Stochastics and RSI. Okay. But focus your trading on price action, price movement, support and resistance, trend lines on your chart, and volume and chart patterns. Once you have all that down pat, then you can simply go on and add the more complex indicators as your secondary decision-making capability. And you'll find that you'll be a much better trader. And remember, overbought and oversold, which to me is the fifth interpretation of a signal, because many indicators will give you overbought and oversold conditions regardless of what type they fall into. Too many traders mix up overbought and oversold with buy and sell. The thing is, an overbought market can remain overbought. An oversold market can remain oversold. So remember, when the trend is strong, banded oscillators can remain near overbought or oversold levels for extended periods. An overbought condition does not indicate that it is time to sell, nor does an oversold condition indicate that it is time to buy. In a strong uptrend, an oscillator can reach the overbought condition and remain so as the underlying security continues to advance. A negative divergence may form, but a bearish signal against the uptrend should be considered suspect. So remember that. So there's many advantages, choices, pros and cons of everything, but building your system and learning how to trade from price action in your charts needs to be mastered and conquered before you drop down to depending on indicators. And remember, technical analysis is a very broad field, and technical indicators is just one small part of this overall field known as technical analysis. And on that note, thank you very much for joining us. You can see a recorded copy of this class, as I mentioned earlier, by going to www.investing.com in about 24 hours. And you can just go to the education tab and then look for webinars on demand. And also, if you have a second, go to www.cmstrader.com and look at their education offerings. They'll explain everything that we have discussed this evening and provide you more in-depth details. So thank you very much for joining us and have a wonderful evening. Bye now.